What if I told you your savings account was secretly robbing you? Imagine waking up to find your hard-earned cash has been silently shrinking while you slept. Sounds like a nightmare, right? Well, for millions of people, it's not just a bad dream, it's financial reality. But here's the kicker. The very thing most people trust to grow their wealth might be the biggest obstacle to their financial freedom. In today's video, we're pulling back the curtain on the cash myth and revealing 8 powerful assets that could turbocharge your wealth-building journey beyond the traditional savings account. Are you ready to break free from the savings trap and learn the secrets the ultra-wealthy don't want you to know as we break down each option, discussing the pros, cons, and how to get started? Buckle up because we're about to embark on a money-making adventure that could change your financial future forever. Now that we've exposed the hidden dangers of relying solely on cash, let's dive into the game-changing alternatives. Each of these options offers unique advantages over traditional savings accounts, and we'll break down exactly how they can work for you. Let's kick things off with our first asset that's leaving cash in the dust. Asset number 1. Real estate investment trusts, or REITs. Let's kick things off with our first wealth-building powerhouse. Real estate investment trusts, or REITs. Imagine owning a piece of prime real estate without the hassle of being a landlord. Sounds too good to be true? Well, that's exactly what REITs offer. What are REITs? REITs are companies that own, operate, or finance income-generating real estate. When you invest in a REIT, you're essentially buying a slice of a diverse real estate portfolio. Why are REITs better than cash? 1. Higher returns. Historically, REITs have outperformed savings accounts by a wide margin. 2. Regular income. Most REITs pay out dividends regularly, providing a steady income stream. 3. Diversification. REITs give you exposure to real estate without putting all your eggs in one property basket. 4. Liquidity. Unlike owning physical property, you can buy and sell REIT shares easily. How to get started? 1. Research different types of REITs, residential, commercial, healthcare, etc. 2. Consider investing through an ETF for added diversification. 3. Start small and increase your investment as you get more comfortable. REITs are not only juicy, there are potential drawbacks like 1. Market volatility can affect REIT prices. 2. They are sensitive to interest rate changes. Remember, like any investment, REITs come with risks. But for those looking to dip their toes into real estate without becoming a full-fledged property mogul, REITs can be an excellent alternative to letting your cash gather dust in a savings account. Have you ever considered investing in real estate? What's held you back? Or have you successfully dipped your toes into it? Share your thoughts in the comments. Asset number 2. Dividend-paying stocks. Now let's move on to our second wealth-building asset, dividend-paying stocks. If REITs are about owning a slice of real estate, dividend stocks are about owning a piece of profitable companies and getting paid for it. What are dividend-paying stocks? These are shares in companies that regularly distribute a portion of their profits to shareholders. It's like getting a thank you payment for being a part owner of the company. Why are dividend stocks better than cash? 1. Dual income streams. You can benefit from both stock price appreciation and regular dividend payments. 2. Compound growth. Reinvesting dividends can significantly boost your returns over time. 3. Potential hedge against inflation. Many companies increase their dividends over time, helping to combat inflation. 4. Ownership in real businesses. You're investing in tangible companies, not just numbers in a bank account. How do you get started? 1. Look for companies with a history of consistent dividend payments. 2. Consider dividend aristocrats. Companies that have increased dividends for 25+ consecutive years. 3. Start with a dividend-focused ETF for instant diversification. What are the potential drawbacks? 1. Companies can cut or suspend dividends during tough times. 2. High-yield dividends might signal a company in trouble. Remember, while dividend stocks can be a great source of passive income, it's crucial to do your research and not chase yield at the expense of company quality. What's your take on dividend investing? Have you tried it? Let us know in the comments. Hold up, future millionaires. Don't let these wealth-building secrets slip away. Hit that subscribe button now and join the Money Whisperer family for weekly doses of financial wisdom that could change your life. Smash that bell icon too. Trust me, you don't want to miss a single upload. By subscribing, you're not just growing your wealth, You're helping us build a community of savvy investors. Together, we'll master the art of making money work for us. Subscribe now, your future self will thank you. Now let's continue. Asset number 3, peer-to-peer lending. Ready for our third wealth-building asset? Let's talk about peer-to-peer lending, or P2P for short. Imagine being the bank, earning interest by lending directly to borrowers. That's the essence of P2P lending. So what is P2P lending? Well, P2P lending platforms connect investors with individuals or businesses looking to borrow money. You lend your money and earn interest as the borrower repays the loan. Why is P2P lending better than cash? First, higher interest rates. P2P lending often offers significantly higher returns than savings accounts. Second, regular income. You receive monthly payments of principal and interest. Third, diversification. You can spread your investment across multiple loans to reduce risk. And fourth, control. You choose which loans to invest in based on risk and return preferences. Now, how do you get started? First, research reputable P2P platforms like Prosper or Lending Club. Second, start small and diversify across multiple loans. Third, understand the risk grades assigned to different loans. But, what are the potential drawbacks of P2P lending that you must consider before you venture into it? First, the risk of default. Borrowers may fail to repay loans. Second, less liquidity. Your money is typically tied up until the loan is repaid. P2P lending can be an exciting way to earn higher returns, but it's crucial to understand the risks involved and only invest money you can afford to lose. Have you ever considered being the lender instead of the borrower? What's your biggest concern about P2P lending? Share your thoughts in the comments. Asset number 4, exchange-traded funds or ETFs. All right, money-savvy friends, it's time for our fourth wealth-building asset, exchange-traded funds or ETFs. Think of ETFs as a buffet of investments. You get a little bit of everything in one serving. So, what are ETFs? ETFs are baskets of securities like stocks or bonds that trade on an exchange like individual stocks. They offer instant diversification and typically track a specific index or sector. Why are ETFs better than cash? First, diversification. One ETF can give you exposure to hundreds or thousands of companies. Second, low cost. ETFs generally have lower fees than actively managed mutual funds. Third, flexibility. You can buy or sell ETFs throughout the trading day. And fourth, accessibility. ETFs exist for almost every market, sector, or investment strategy. How do you get started, my money-savvy friends? First, determine your investment goals and risk tolerance. Second, research ETFs that align with your objectives like total market, dividend focus, or specific sectors. Third, consider starting with broad market ETFs for maximum diversification. But what are the potential drawbacks of ETFs? First, market risk. ETF values fluctuate with their underlying assets. Second, tracking errors. Some ETFs may not perfectly mirror their target index. ETFs can be a fantastic way to build a diversified portfolio without the complexity of choosing individual stocks. They're like the Swiss Army knife of the investment world, versatile and efficient. What's your experience with ETFs? Any favorite ones you'd like to share? Let us know in the comments. Asset number 5, high-yield savings accounts. Now, I know what you're thinking. Didn't we just say we're ditching the bank? Well, hold on to your hats, because our fifth wealth-building asset is a twist on traditional savings, high-yield savings accounts. So what are high-yield savings accounts? These are savings accounts that offer much higher interest rates than traditional banks, often found at online banks with lower overhead costs. Why are high-yield savings accounts better than regular savings? First, higher interest rates, often 10 to 20 times higher than traditional savings accounts. Second, FDIC insurance. Your money is typically insured up to $250,000. Third, liquidity. Easy access to your funds when needed. And fourth, no market risk. Your principal is safe from market fluctuations. How do you get started? First, research online banks offering high-yield savings accounts. Second, compare interest rates, fees, and account features. Third, consider factors like minimum balance requirements and withdrawal limits. High-yield savings accounts have some drawbacks you must diligently consider before you invest. First, rates can change. High-yield rates aren't guaranteed to stay high forever. Second, online only. Many high-yield accounts are with online banks, which might not offer in-person services. While not as exciting as some of our other options, high-yield savings accounts can be a great place for your emergency fund or short-term savings goals. It's like giving your cash a promotion. Same job, better pay. What's the highest interest rate you've seen on a savings account? Share your finds in the comments. Asset number 6, cryptocurrency. Let's dive into our most controversial wealth-building asset, cryptocurrency. It's the new kid on the block that's been making waves in the financial world. What is cryptocurrency? Cryptocurrency is a form of digital or virtual currency secured by cryptography. Bitcoin is the most well-known, but there are thousands of different cryptocurrencies. Why can cryptocurrency be better than cash? 1. Potential for high returns. Some cryptos have seen astronomical growth. 2. Decentralization. It's not controlled by any government or central authority. 3. 24/7 crypto markets never close, allowing for constant trading. 4. Technological innovation. Many cryptos are built on blockchain technology with various applications. How to get started? 1. Educate yourself about blockchain technology and different cryptocurrencies. 2. Start with a reputable exchange like Coinbase or Binance. 3. Begin with a small investment you can afford to lose. 4. Consider a hardware wallet for added security. What are the potential drawbacks? 1. High volatility. Crypto prices can be extremely volatile. 2. Regulatory uncertainty. The legal status of crypto is still evolving in many countries. 3. Security risks. If you're not careful, your crypto can be stolen by hackers. Cryptocurrency is not for the faint of heart. It's a high-risk, potentially high-reward asset that requires careful research and a strong stomach for volatility. What's your take on cryptocurrency? Exciting opportunity or dangerous bubble? Share your thoughts in the comments. Asset number 7, index funds. Let's dive into one of the most powerful wealth-building tools available, index funds. Imagine a basket filled with a little piece of hundreds or even thousands of companies. That's essentially what an index fund is. An index fund is designed to track a specific market index like the S&P 500, which represents 500 of the largest US companies. When you invest in an S&P 500 index fund, you're basically buying a tiny slice of all these companies at once. Now, why are index funds such a game changer? Let's break it down. 1. Low fees. Unlike actively managed funds, where you're paying someone to pick stocks, index funds are passive. They simply mirror the index, which means lower fees. And lower fees mean more money stays in your pocket, compounding over time. 2. Instant diversification. With one purchase, you're investing in a broad slice of the market. It's like buying pizza instead of individual toppings. This spread reduces your risk. If one company tanks, you're not losing everything. 3. Consistent performance. While they might not shoot the lights out in any given year, index funds have historically outperformed many actively managed funds over the long haul. It's the tortoise versus the hare, and slow and steady often wins the race. 4. Simplicity. You don't need to be a Wall Street whiz to invest in index funds. It's a set-it-and-forget-it approach to investing. No need to constantly watch the market or make frequent trades. 5. Transparency. With an index fund, you always know what you're investing in. The holdings are based on the index it tracks, which is public information. Now, index funds aren't without risks. When the market goes down, your index fund will too. But historically, over long periods, the stock market has trended upwards. Also, not all index funds are created equal. Some track broad market indices, while others might focus on specific sectors or countries. It's important to understand what index your fund is tracking. Index funds can be an excellent foundation for many investment portfolios. They offer a simple, low-cost way to invest in the stock market, making them particularly attractive for long-term investors and those new to investing. Remember, while index funds can be a powerful tool, it's crucial to consider your personal financial goals and risk tolerance before investing. And as always, diversification across different types of assets is key. Asset number 8, Treasury inflation-protected securities or TIPS. Last but certainly not least, let's talk about Treasury inflation-protected securities or TIPS. These are like the superhero of government bonds, designed to protect you from the villain we call inflation. TIPS are a type of US Treasury security that's indexed to inflation. This means they're designed to protect investors from the erosion of purchasing power that inflation can cause. Let's break down how TIPS work. 1. Principal protection. The amount you initially invest, the principal, increases with inflation and decreases with deflation. It's like your money is wearing a special suit that grows or shrinks with the economy. This adjustment is based on the Consumer Price Index, CPI, which measures changes in prices paid by urban consumers for a basket of goods and services. 2. Guaranteed returns. TIPS are backed by the full faith and credit of the U.S. government. This means that unless the entire U.S. economy collapses, you're getting your money back. This makes TIPS one of the safest investments available. 3. Inflation shield. While regular bonds can lose value when inflation rises, TIPS adjust to keep pace. It's like having an umbrella that expands as the rain gets heavier. This feature makes TIPS particularly valuable during periods of high inflation. 4. Predictable income. TIPS pay interest twice a year at a fixed rate, but here's the kicker. That rate is applied to the adjusted principal. So if inflation rises, so does your interest payment. This ensures that your real return, after inflation, remains stable. 5. Deflation protection. If there's deflation, your principal won't drop below the original amount you invested. At maturity, you receive either the inflation-adjusted principal or the original principal, whichever is greater. TIPS aren't without drawbacks. Their yields are typically lower than traditional Treasury bonds because you're paying for that inflation protection. Also, if inflation is lower than expected, TIPS may underperform conventional bonds. TIPS can be purchased directly from the U.S. Treasury through Treasury Direct or through banks and brokers. They're also available through mutual funds and ETFs that specialize in TIPS. TIPS can play a crucial role in a diversified portfolio, especially for risk-averse investors or those nearing retirement who want to preserve purchasing power. They provide a unique combination of safety and inflation protection that few other investments can match. As always, while TIPS offer unique benefits, it's important to consider your overall financial strategy and consult with a financial advisor to determine if they're right for your portfolio. Let's recap our wealth-building assets that are considered better than cash. 1. Real estate investment trusts, REITs. 2. Dividend-paying stocks. 3. Peer-to-peer lending. 4. Exchange-traded funds, ETFs. 5. High-yield savings accounts. 6. Cryptocurrency. 7. Index funds. 8. Treasury inflation-protected securities. And there you have it, folks. 8 powerful alternatives to letting your money stagnate in a traditional savings account. Remember, building wealth isn't about making drastic changes overnight. It's about making informed decisions and taking consistent action over time. Implementing even 1 or 2 of these strategies can significantly boost your financial growth and security. Start small. Maybe begin with researching index funds or setting up a high-yield savings account. As you gain confidence and see your wealth start to grow, you can explore the other options we've discussed. The key is to be consistent and patient. Rome wasn't built in a day, and neither is lasting wealth. But with these tools in your financial arsenal, you're well equipped to outpace inflation and build a robust financial future. Remember, every journey begins with a single step. So, which of these wealth-building assets will you explore first? Your future self will thank you for the action you take today. Keep learning, keep growing, and watch your wealth flourish. If you found value in this video, don't forget to hit that like button and subscribe for more money-whispering wisdom. And if there's a particular asset you'd like us to dive deeper into, let us know in the comments. Your feedback shapes our content. Until next time, this is the Money Whisperer, reminding you that building wealth is a journey, not a destination. Keep learning, keep growing, and I'll see you in our next financial adventure.